Hello, I'm Hayley Atkin, and I'm delighted to be joined today by Florian Ielpo as we discuss the latest macroeconomic investment views from the cross-asset solutions team. Florian, performance across asset classes has been strong this past quarter. What have been the key drivers?
We think that there are three key elements that explain basically what we've had in terms of performance that belongs basically to the macro environment. The first one is that we've seen a continuation of this very good growth momentum we've had since the beginning of the year. It touches both developed and emerging economies, so it's something very positive overall, and it sustained the performance of stocks. The second element is what we've seen in terms of inflation. We've seen a continuation of this reflation trend, basically not exactly in market, but basically in the economy itself. It was, however, strong enough to see a surge in rates, but still reflation remains on its way, and it explains a bit of the performance over the third quarter. And the third element is the very low market stress environment we've had. Basically, when you look at the key elements you would use to measure market stress, would it be credit spreads, liquidity, or volatility? They're all very low, in very low territories. Currently, volatility is in the neighborhood of 9 to 10%, which is by historical standards very low. And that finishes this overall view of the macro environment and explains very well the performance we've had over the third quarter.
And with this in mind, what are your key investment themes for the coming months?
When we think back of our key investments during the third quarter, we think that two of them remained valid. And to that, we've had a new one. So the two that remain valid are the growth story and the inflation story. We still see very limited evidence that growth should be derailed anytime soon, both for emerging and developed economies actually, even though we see China as being a bit of the lame duck, if you want, in this game. Inflation should progressively increase, not up to levels that would threaten the policy of central banks, but still we see a continuation of the reflation trend. What's very new is what we expect in terms of market stress. Two main reasons for that. First, we are currently seeing valuations that are very high, and this will increase the sensitivity of markets to bad news. That's the first element. And the second element is what's happening in terms of growth and inflation is actually helping central banks to get away from the economy, to diminish progressively their intervention within the economy. And the first element of that will be a lower liquidity. And with this lower liquidity, we also expect an increased sensitivity of markets to bad news, and there are always bad news around. We are especially thinking of geopolitical and political risks these days.
And finally, how are these themes reflected in your portfolio positioning?
The core convictions that we have are reflecting through an overweight position in equities. It's both developed and emerging for the growth reasons. We have an overweight in inflation break-evens and commodities to profit from this reflation trade that we think that will unfold during the quarter. And lastly, we are actively looking for sources of hedges. We're looking in three directions currently. One is to use options, so we are buying puts on equities, as simple as that, on a regular basis. Two is that we are looking at the currency market to look for hedges opportunities. For example, we are long Japanese yen versus Korean won as a hedge against geopolitical risk. And finally, we also actively use our beta exposure to markets, which means that basically we go to cash whenever we see fit, when we see that there will be an upcoming risk, then we don't hesitate to go to cash.
Thank you very much for listening, and if you'd like to read more of our macroeconomic views, please visit our website.